The risks of a recession are rising, now at 35%. I feel like Brian Gumbel. What?
So, I think you have to take this into context. So this is a model that we put into place a couple of years ago just to assess a probabilistic forecast of a recession. We've been monitoring that for quite some time. That has been sitting at, say, sub 20% sort of risk levels, which is about right. That's you see a recession about 1 out of 7 years. So that's where the model should sit on average.
What do you see?
Now all of a sudden we're at 35%.
Yeah, what are you seeing?
Sorry, go ahead.
Why?
So what it's seeing is it has a contrast here between a buildup in excesses and some near-term factors that are kind of directional in nature. Basically, we've seen the economy expand enough here that we have a buildup in excesses that I wouldn't say it's really all that material. It's higher than it normally is, and therefore provides room for a pullback in the economy. To put into context, that 35% chance of recession, that's more of a yellow light than a red light, which is why we're actually still reacting somewhat positive to this pullback in the markets. A yellow light meaning that 35% chance, that's 1 in 3. That's not a guaranteed recession. That's not a greater than 50% chance. It's not the base case. Yeah. It just tells us that the economy is more likely to continue. But, maybe it's a little bit fragile. There are things that can come at it from the left or the right that could knock it off its axis.
I understand it's what 35 is. It's 1 out of 3. It's not 50, which would be 1 out of 2. We got all that, but what excesses? I'm just trying to figure out, what are you talking about? Where is it? Housing? Is it? Why go from 20 to 35?
There's a couple of broad observations
that's what
in
we're
there.
all grappling with. What are we not seeing that's causing the market to go down? Because you got unemployment where it is. Inflation doesn't seem to be a problem. I don't know. Is it global growth slowing? Is that it?
So I think what it's picking up on is GDP is finally at potential level as estimated by the SIBO. It's basically kind of caught up with all of the downfall that it had from the 08-09 recession. It's finally caught up to potential sort of levels, number one. Number two, you now have an employment market that's full enough that you're starting to see some wage growth and some pickup and flow through into inflation. It's not really that material, but it's higher than it was before. And as a result of that, the other thing that's picking up on is that the Federal Reserve is starting to increase interest rates, and that's putting some pressures on the overall system. That was showing through on the housing side throughout this past year. It's showing up in other areas. It's really still not that material, but it's enough that the model's picking up its probabilities, and it's saying that we're in a more fragile system than we normally are.
Jason, it's Joe. So if you think back to the 08-09 recession, I think about the credit derivatives. If you think about 2000, 2001, you think about the dot-com bubble bursting. Go back to 90-91. Think about the S&L crisis. So 3 major recessions. The common denominator for each of those recessions is a financial market imbalance, not some form of economic contraction. What's the financial market imbalance right now that would cause a recession in 19 or 20?
I don't think there's as much of a financial market imbalance. The only one that we could probably point to that we have been keeping our eyes on has been this favoring of the market for growth-oriented businesses. That's been represented in the FANGs. That's been represented in the number of unicorns that come through the private equity side of the equation. You see similar sort of companies in smaller cap areas. You even see it abroad to some degree. Basically, an overwillingness of investors to pay for growth, pay for companies or invest in companies that effectively have zero profits right now, give them a lot of money, and hope that everything works out.
Let me get to Bill. So, Bill, I think, as far as your comments here, you don't think we need to look any further than the Fed staying at zero for so long. They've sort of orchestrated this buildup in credit, and maybe just trying to, when you go the other way, this is what you get when you try to go the other way. Do you have to look beyond that to understand why the markets are in flux?
I think that's the primary factor here. The Fed and central banks around the globe are trying to get out of the business of suppressing volatility in financial markets, and that's not going to be an easy thing to do. I'm reminded of Al Pacino in The Godfather Part 3 when he said, just when I thought I was out, they're pulling me back in. And the markets are not going to take it easily for the Fed to stop suppressing volatility.
Yeah, Terranova's taking that. He's not saying anything. Okay. Relax. Okay. Yeah. All right. Good. That is used a lot.
The Godfather?
No, that you pull me back
quote.
in. I mean, for an absolutely awful movie. I mean, that definitely is. I mean, compared to.
An awful movie?
Compared to G1 and G2?
Oh,
yeah,
okay.
That's on a relative basis. Bill, where do we go on yields 10-year? We hit the high in October for the year, 326. How do we do in 2019?
I mean, I think that it's really risk assets that are driving the markets right now. The first move higher in volatility this quarter was driven by the Treasury market, but since the Fed meeting on November 8th, Treasuries have settled back into the background. It's all been driven by risk assets. So I think that if the equity markets and high-yield bond markets can find their footing, that I think Treasury yields are going to start moving higher once again.
Joe, to that question of possible recession, is the market looking more than just 2019 ahead, 2020, 2021? And is the chance then possible?
See, I don't know that the market is pricing in an economic recession. I agree more with what Bill is saying. I think the market is understanding that we're in a liquidity recession. And the liquidity recession is coming from the fact that from late 2012 into early 2015, the Fed's balance sheet went from $2.8 trillion to $4.5 trillion, and now we're back to $4 trillion. And the removal of that liquidity in an environment where you've implemented the Volcker rule, so you've got less market making, less proprietary trading on the part of the banks, you're going to have less liquidity. We all saw the Goldman Sachs note. I saw you report on it, where you're seeing 18 versus 17, basically 42% less volume available for equities, 70% if you go to the futures market. There's less liquidity available. We're in a liquidity recession, and I think it's something that the Federal Reserve has to understand.